Gopani and chat about what he's making of the markets. Jinesh, hi, good morning. Good to have you on the show. Jinesh, what I wanted to understand is, what these global brokerages are now raising red flags about. Everyone from a CLSA to a Macquarie believe that energy costs, the fact that we're sitting at escalated valuations, do pose a downside risk for India equity markets. Having said that, month to date, we've seen the return of FIIs back. In fact, in the last 2 days alone, we've seen buying to the tune of about 1,000 crore rupees coming in. That said, do you believe and are you in concurrence with the brokerages which are raising those red flags on account of what they foresee as margin pressure for India Inc. and for stocks to underperform from here?
So I would say clearly, if you look at, we have a very good rally over the last 15-month period, and obviously there has been a great a swing in the economic activity as well, even after COVID 2.0. So I would say when economy is on a tear and doing well, in fact, the recent channel checks also on Diwali has been pretty good. So there has been a good momentum back in the economy. However, some part of it would have already been discounted the way stocks have performed over last 12 to 18-month period. And maybe we are stretching a bit going into FY24 kind of discounting some of the stocks to that level. So maybe to that extent, I think obviously there would be some consolidation in the market, which is expected because obviously we need to see next 1 or 2 quarters of economic growth as well as how companies are really performing in this volatile period, especially because of the margin pressure and the raw material surge which has come in. So I would say more of a consolidation phase than a correction phase in a big way, unless and until we have a sort of a black swan event again, which is like a global event or a domestic event. I would say more of a consolidation phase between, let's say, 16,500 to 18,500 level, and maybe wait for 1 or 2 quarter earnings growth and roll forward to FY24. I would say from a brokerage house point of view, though I am not an expert, but I think it is more to do with how China has performed over last 12 months and whether it makes sense to move some money from India to China, given their underperformance, which has been very stark. If you really see the YTD performance of Indian indexes as well versus the Hong Kong or China indexes. I think it is more to do with that kind of a phenomenon to move some money from India to China, but on a standalone basis, if the economy is doing well and the momentum continues beyond pent-up demand, then I think it is more of a wait and watch game than just selling from in the market.
Sure. So, Jinesh, at this juncture, with your market view, where do you feel there's money to be made? What are your big overweights and underweights sectorally?
Maintain that not all companies will deliver to the kind of valuation they are trading, and this is clearly been seen in Q2 numbers, where there has been volatility around growth or around margins, depending on the sectors and the companies how they have delivered in terms of execution. So clearly, the Me Too companies will not benefit from here on, and only companies which are able to navigate this difficult phases of this supply chain issues, the raw material surge, inflationary pressures, and having pricing power to some extent manage the margins while maintaining the growth momentum. They should be doing well. So I would say a strong brand or a strong pricing power company or a strong business model which has edge over others would continue to do well. Whereas the Me Too companies will find it difficult to outperform quarter after quarter because that reflationary trade where everything was down, economy was zero, and all stocks managed to move up because of that recovery and the global liquidity and the local liquidity coming. I think that time is over. Now it is going to be a difficult ask to make money, make returns from the stocks, and that is where a good governed company with solid business models will thrive well.
Okay, good morning. The one question I also wanted to ask you, and so many of us are having this conversation every day, so it'll be great to get your views too. If there's been one big theme that you've seen the last couple of weeks, it has to be the gold rush for IPOs, right? It's the flavor of the season. You'll have the biggest of them all, PTM, expected to list on Thursday. Then you'll have the new wave, whether it's Farm Easy, Delivery, MobiQuick, Oyo Rooms, Ola Cabs, all of them. How are all of you figuring out what's the right weightage to have these kind of tech companies in your portfolio, if have them at all? Look at Zomato, it's doubled its share price. Even a disastrous quarterly result for Nykaa, still the share price recovered.
Yeah. So I would say you are in a significant digital super cycle, and that is being witnessed, especially more after COVID. The mindsets of the companies have changed, and many have understood that there has to be an omni-channel kind of a model than having only a brick and mortar model, or having only a platform online model. So clearly, it is also learning for us, because these are new companies which are and the new themes which are getting listed in the market. So we have to be careful and cautious, but if the theme is good, if there is scalability of the business model available, maybe the way we are trying to do is nibble around, try to put some money, wait for quarter on quarter numbers, and then eventually take a bigger call. Maybe not now, maybe after 6 months or 12 months. That is this valuation really justified for the growth what they are delivering, or it is just the IPO frenzy which is in place. So obviously, all net companies might not do well maybe 2 years down the line, but there would be one or two big winners which will really become, let's say, star of the market or the winner of the market, and might become part of Nifty as well. Who knows? So I think it is more of a basket approach, not to miss any story to start with, but at the same time be very, very active, agile, and cautious to ensure that it doesn't impact your portfolio in case the company goes down the drain maybe after 12 months.
Okay, fair point. Now, if I were to look at your portfolio as well, financials has the largest weightage, right? At 30%. A part of me was to say, "Apna time aa gaya," because you're seeing the financials make a comeback, and how. What's your assessment as far as this space goes? On one side, you've got the likes of Bajaj Finance, which is only going one way, which is up, up, up. You've had some very bullish commentary now from HDFC wanting to partner with fintechs, ICICI's blockbuster listing, and at the same time, PSU banks coming back.
In financial, first is you need credit growth. At least on the retail side, we are witnessing growth rates coming back, especially during Diwali. The channel checks what we have done, there has been a decent activity on retail side, as you also including the home loan piece. However, the corporate credit growth will take a longer time. Even working capital cycle growth might take a longer time, because most of the companies are becoming debt free. They are becoming very agile with this digital initiatives what they have taken, and everyone wants to be just in time kind of a situation, rather than taking big loan. So I think there is a deleveraging mood among corporates. If you really do the analysis, top 20 large corporates would have been debt free, or would have been trimming down their debt as the opportunity comes. Even the mid good corporates is trying to trim down debt and trying to raise capital from the market, because capital is available in plenty as of now, and good corporates are able to raise capital by 5-10% dilution. On the MSME side, there is a sort of I would say, no interest from many banks to really go for a higher credit growth, because there is a risk of NPA or the asset quality issues, because that piece is always a bit a risky piece to go for. So I think retail is the only place where really there is going to be a huge opportunity for growth, and banks who are able to embrace on retail side of the story should do well. So overall credit growth might take time, which might lead to lower credit growth rates and on the overall number. But banks or the NBFCs who are focused on retail, we feel that they will come out of this, come out and deliver good growth numbers in quarters to come.
Right. Jinesh, wanted to figure out how is it that you're approaching the entire realty theme, especially at a time when many brokerages, for instance, this morning itself, there was a note coming in talking about as to how not just realty but the ancillaries and construction as well is bound to get a good fillip. The fact that they've underperformed and lagged the rest of the market for a while now, along with residential sales, you will see non-residential sales as well make a comeback, and perhaps ancillaries like paints, Havels, etc. as well are something to be looked at.
Yeah, no, I think clearly real estate has been a surprise for even for us. The way the home sales have happened over the last 6-7 month period, thanks to lower cost of funds with the lower interest rates at 6.7, 6.8% level, and also resurgence in the economy, which has really helped many people to look out for homes, which was not expected because economy had come to scratching halt and people were worried about whether there will be huge job losses. But fortunately for Indian economy, at least what we see is the job losses has not been there. In fact, there has been an improvement in the employment generation, what we see starting from technology sector, and that has really led to significant resurgence in some of the cities like Bangalore, Pune, even Noida, Gurgaon, and even Bombay. So I think clearly real estate has also with state government's effort to reduce stamp duty has further helped to reduce the cost of buying, and that is what has led to significant movement in the real estate sector. So which is a good sign, and clearly that should further, if economy continues to do well and the employment generation continues, which we feel we are in good shape, then I think clearly the real estate proxies, be it paint companies or the adhesive companies or building material companies, all at the end of the day would do well if they are in if they have resources in place like raw materials, if they have labor in place, and if they are financially very strong. One big thing, in fact, which has happened, and that is not in real estate sector, this is across the board. There has been a significant shift in market share from unorganized to organized player, and that is where the listed companies have been benefiting by gaining market share all across, and be it real estate companies, building material companies, and also any other sectors. And that has also led to significant resurgence in the earnings growth number of some of these great companies who have improved their market share and are able to really demonstrate good numbers vis-a-vis the valuations what they are trading at.
Right. Okay. The other thing, Dinesh, I wanted to talk about is, part of your recent sales, and wanted to get your opinion here on some of the auto majors. Where within autos, considering each of them is such a diverse story and with each of them in the EV race now, where is it that you find your bullish bets, and where is it that you, would recommend underperformance or under ownership?
See, I think the way world is moving in the auto space, and clearly there has been a lot of consumer demand coming on the EV side. So even in two-wheelers or even in four-wheelers, if you do some analysis of the global world, especially China and US, clearly there has been lot of consumer related demand for the product, which is electric vehicle, and the companies will have to move what consumer wants, and if companies are not able to change that mindset, it will become difficult for them to continue to maintain market share, and the companies which are able to move that side and understand maybe in next 3 4 5 years, this is what consumer is going to ask for the product in terms of product, and there is an infrastructure which is laid down by the government for that technology, then I think clearly those companies will benefit and will do well. So clearly, it all boils down to the consumer needs, consumer demand. If you really see China, the EV penetration has been through the roof, even during a lower growth phase of last month, 1 month or two. The EV growth rates have been very high, obviously coming from a lower phase. So I think the consumer is becoming more cautious about environment, and that is where the auto companies will have to benefit. I would say some of the auto ancillaries who are either neutral to this change in technology, or they are part of the EV ecosystem. I think they will do pretty well, and some of the traditional OEMs who are embracing this change will do very well.
Okay, we're going to leave it at that. Thank you so much for joining us today on the market to talk about the future strategies and with a particular focus on autos as well as the new tech IPOs.